Good morning, viewers. It's Friday morning, April 11, 2025, and I'm your Sunil Thakker of Sunny Talks Money. Welcome to ST Money 7 a.m. early morning news, where we provide you the latest, concise, and precise stock market wrap with accurate figures and numbers. Stocks surrendered much of Wednesday's stunning jump. The equities sell-off resumed the day after a sharp rally on Wednesday triggered by Trump's pause on reciprocal tariffs. US stocks fell sharply Thursday as investors sought through a global economic outlook that remains uncertain despite drastic improvements over the past 24 hours. Economic angst enveloped every corner of Wall Street as US China trade tensions escalated, sparking a slide in stocks, the dollar, and oil, with liquidations in US assets pointing to disorder in the financial system. A day after the biggest stock buying wave in years, assets tied to the economic cycle was sinking again, with President Donald Trump's mollifying message on trade talks providing little relief. Investors were rushing to game out how the effective freezing of Chinese trade will impact companies and growth. The S&P 500 fell 3.5%. Nasdaq Composite, which posted its biggest gain in more than 2 decades on Wednesday, ended 4.3% lower. The Dow Jones Industrial Average shed 1,015 points, or 2.5%. Bloomberg Magnificent 7 Total Return Index fell 5%. Russell 2000 Index fell 4.3%. The decline accelerated after the White House said the tariffs imposed on China by President Trump in his second term add up to 145%, not 125% it previously indicated. The 125% tariff that President Trump announced on Wednesday afternoon referred only to reciprocal tariff levels, White House officials said, and did not take into account the 20% tariffs Trump had previously levied on China over its role in the fentanyl trade. When the fentanyl based tariffs are added, the second term tariffs are 145%. The staggering US tariffs on China have triggered a tit for tat trade war that has unnerved global financial markets. In return, China said Thursday it would reduce imports of American movies, another bid to strike at US services exports in an escalating trade war between the two countries. Goldman Sachs cut its growth outlook for China, citing the impact of tariffs. The bank now projects China's economy will expand 4% this year and 3.5% in 2026. Market euphoria flipped back to unease despite Trump's signals that he's closed to a first deal on tariffs without naming the country. Concern grew that an escalation of the trade war between the two biggest economies would bring lasting damage to global growth after White House said US tariffs on China rose to 145%. Just a day after financial markets cheered Trump's decision to delay some of his tariff plans, the sell-off on riskier corners of the market suggests growing skepticism that trade talks would be wrapped up in a timely manner, despite White House National Economic Council Director Kevin Hassett saying the US is well advanced in its discussions with economic partners. The first signs of a slowdown in global trade are already emerging as companies around the world hit their own pause button on orders as the US continues to escalate its trade war with China. If anything, this is extending the uncertainty that has already begun to drag on business and consumer sentiment. Wall Street parsed the latest consumer price index, which showed inflation slowing more than expected to a 2.4% annual rate. US consumer prices unexpectedly fell in March amid cheaper gasoline and used motor vehicles. Airline tickets cost less, as did hotel and motel rooms, pointing to declining discretionary spending amid a sharp deterioration in business and consumer sentiment. The CPI dipped 0.1% last month, the first drop since May 2020, after gaining 0.2% in February, the Labor Department's Bureau of Labor Statistics said. Economists had forecast that CPI would edge up 0.1%. While data Thursday showed US inflation cooled broadly in March, the data was calculated prior to widespread levies that risked contributing to price pressures. That may change in coming months as Trump's higher levies filter through the economy. And price declines for services like hotel stays and airfares may be a warning sign that some consumers are cutting back on discretionary spending. Bank stocks and tech stocks were hit hard, retracing some of Wednesday's epic gains. Government bonds were mixed. A solid US sale of 30-year treasuries failed to ignite a rally but signaled appetite for bonds. The yield on the 10-year treasuries advanced 7 basis points to 4.40%. Gold climbed to a new record high in a sign of rising anxiety. Gold prices rose up 3.2% a day after their largest gain in 5 years and settling at a new record high of $3,155 a troy ounce. The dollar extended its decline down more than 1%. The dollar slipped against a basket of currencies. The dollar saw its worst day since 2022. In cryptocurrencies, Bitcoin fell 4.3% to $79,592, whereas in commodities, West Texas Intermediate crude fell 3.3% to $60.31 a barrel. Wall Street's fear gauge, the CBOE Volatility Index, was rising, though far below levels of earlier this week. My take: anxiety around tariffs are alive and well. Volatility works in both directions, down and up. The path forward likely includes more market swings as we do not have a conclusion. In fact, we have the opposite, a likely extension of the tariff negotiation process. Most investors believe that China shot itself in the foot by retaliating. The view from Beijing is different. Many in China read the Trump fold as a sign of US weakness and therefore as a validation of China's decision to escalate. This dramatically affects psychology and attitude, especially about the United States' reliability. The process could have been handled better. The extent of the flow through of higher tariffs into realized inflation remains an open question, one that isn't likely to be resolved until well beyond the 90-day pause window. At the end of the day, we do need to see lower inflation to justify lower rates from the Fed and ease the burden on consumers. However, getting lower inflation due to a material drop in economic activity and thereby jeopardizing the economy isn't the best route to take. And that's why I still believe that anxiety around tariffs are alive and well. And that's the wrap for today, my dear viewers. And if you got value from this, please do subscribe, like, and share this video as much as possible. You can contact me at st@stmoney.com for further information. I will now see you on Monday morning. Have a great weekend. In the meantime, happy investing, stay inspired, and remember, it's all about money.